When could they expect, or when would you expect them to raise rates?
So far what we're seeing is that they're sticking to their plan. And so regardless of whether or not someone likes their plan, that's what they're sticking to. And so far that their plan is basically that they changed their inflation policy somewhat in the sense that they want to have average inflation targeting. So rather than treating their 2% more like an upper, kind of like a ceiling where they start to kind of get concerned, they're basically pointing to the fact that according to the way they measure inflation, they undershot it, the past 5 years or so. And so now they want to mildly overshoot it so that they look back and have, roughly average 2%. And so basically their policy is to not front run inflation expectations. So if they see inflation coming, they don't plan on kind of preemptively hiking rates to deal with that. And so they've described it as they want to see inflation kind of over 2% for a considerable amount of time. And so basically they're aware that we have upcoming base effects. So already March, inflation was over 2% year over year. CPI at least was more than 2% year over year compared to last year, and the April, May, and June numbers are going to be higher because you're comparing to a very low inflationary period of last year, which was the heart of the shutdowns. And so with all the fiscal stimulus in the economy, with reopenings, and with those base effects, we're going to get pretty high numbers. And the Fed is, they're kind of trying to control the narrative by pointing out that, in their view, they'll be transitory and that they don't plan to, do emergency hikes right away. But I think, with the inflation coming down the pike, I think they're starting to gently, tell people that, the tapering is potentially on the horizon, rate hikes are potentially on the horizon, but they're not getting to them very quickly until they actually see persistent inflation the way they measure it above 2% for, a period of time.
In your article, you talked about Bitcoin, gold, and equities. Before we talk about how market cap applies to gold, I like to just first ask you, generally speaking, which of these assets that you've discussed in your article do you think is the most overvalued?
So by most metrics, I mean equities are more overvalued than other asset classes. Gold historically is there's different metrics that show by the most conservative metrics it's undervalued. By more aggressive metrics, it's maybe fairly valued. And so, for example, if you look at gold compared to other commodities, still you're generally on the more pricey side for gold. If you look at gold, how many ounces of gold it takes to buy the median house, you're still looking a little bit more on the pricey side for gold. But if you're comparing gold to the amount of broad money supply in the system, if you do it on a per capita basis, or if you take into account gold's inflation rate, basically the mining rate, that's about fairly valued. If you look at, for example, how much gold the U.S. Treasury has compared to the money supply, that's very cheap by most metrics. Basically they have a smaller percentage of broad money supply backed by gold, indirectly, than most times in history. So there's a range of different metrics, but overall, gold's not too frothy at the moment, especially after the 8-month correction that it's gone through. Bitcoin's always a challenging one because it's a smaller asset. It's in the process of being adopted. There's different ranges for estimates for how what is basically what is its total addressable market size. So could it reach half the size of gold? Could it surpass gold? Basically, depending on who you talk to, it could be anywhere from 0 to multiple times the size of gold. But basically, again, we've been in a large correction, more like a consolidation for 2 months now, where Bitcoin's been choppy and sideways, and so that's taken some of the heat off. And so, whereas if you look at the stock market, that's where, but even there, it's challenging because the big curveball is that if you look at the dot-com bubble, you had treasury yields of like 6%. And so the fact that stocks were so highly valued compared to bonds made stocks clearly a worse choice than bonds in that environment. And that ended up being, forward true. It was much better to have bonds. The problem now is that bond yields are so low that actually based on the equity risk premium, stocks still aren't overvalued. And so basically the way to interpret that metric is that stocks are expensive, but then in many metrics, bonds are even more expensive. And so that's the challenge that investors find themselves in, is that the three largest asset classes are the bonds and cash, equities, and real estate. And so they're basically bouncing back between all these different areas that are overvalued.
Now, I'm curious to learn more about what you just said in regards to gold market capitalization. Your definition for the equities it makes sense. I mean, that's a pretty standard definition for the market cap of a stock or a broad index. How do you apply that to gold?
So gold's trickier because it's obviously we don't know the exact amount of gold that exists in the world. But that for example, the World Gold Council has public estimates for how much gold has been mined and is still available. Because virtually all gold that is mined stays in circulation because that's one of the traits of gold is that it's infinitely reusable. Small amounts of get thrown out in electronics and things like that, but the majority of it's still around. And so if you go by their estimate based on, and then multiply that by the price of gold per ounce, that's where you get, a range of maybe 10 to 12 trillion in market capitalization. But then if you say segment that and say, okay, what is the percentage that consists of private investment? Well, that's only, it's several trillion. It's much less than 10 trillion. And so in that context, that's still a very small percentage of net worth. And so that's actually one of the reasons why when people say, Bitcoin is going to displace gold, I point out that in the grand scheme of things, we have there's more than $500 trillion in assets worldwide, and so both of them are actually very small ponds in the ocean of assets. And so if it's more like I compare those to the size of the global bond market rather than get concerned about which one's going to take market share from the other.
Now, you did say that Bitcoin has been consolidating and it's the heat has fizzled off, so to speak. Where is the capital flowing? Is there evidence that it's flowed to a competing asset, equities, gold, anything that a Bitcoin investor could be interested in?
Well, we've seen a few different areas. One is we've seen somewhat of a resurgence of some of the mega cap stocks, right? So they also had a correction, along with gold, more or less, ever since rates started rising in summer of 2020. A lot of those big tech stocks have kind of gone sideways. Some of them have corrected, and in more recent, the past month, a lot of those have broken back out, and so capital's flowed back into those. We've also seen the classic alt season phenomenon. So generally, when Bitcoin has bull markets, there are periods of time where the thousands of other cryptocurrencies that are created start actually outperforming, and that's basically that investors are going out on the risk curve, right? So kind of like how if gold has a bull market, people buy gold and people buy large cap gold miners, and then they start speculating into exploration companies. And so basically, what you're seeing in the crypto space is that Ethereum's doing very well. That's the second largest cryptocurrency. And then if you go down into DeFi protocols and things like that, a lot of those have been explosive. You also see NFTs, they've taken some of the heat away. We also, of course, had that big Dogecoin spike. And then, recently you've had a correction in multiple currency of them. Ethereum's been particularly strong over the past, couple weeks. And so you kind of see these rotations that are happening around the margins in that space. We've also seen gold kind of showing some signs of, not really, rising, but it's been somewhat consolidating after a correction. So that basically we seem to be having less capital flowing out of gold, and then we see some stabilization there.